Good afternoon and welcome to the Danna-Gracey webinar on what happens to your healthcare practice if you cannot practice. I want to introduce you to our presenter today, Wes Caldwell, who is a disability and benefits specialist for Danna-Gracey. To give you a little bit of background on Wes, he has over 27 years of experience. He has a background in the financial services industry, but he specialized in areas of tax-advantaged asset protection strategies and advanced wealth transfer concepts. And he is an expert in coordinating benefits for physicians and their staff. So with that, I'd like to hand the reins over to Wes and have a great webinar.
Thank you, Wendy. Good afternoon and welcome. I'm going to spend a few minutes just going over how important disability coverage is and disability planning is for the physician and surgeon market, and go over what's available in the market. There's a lot of misconception on what's available and what's not available, and how we can use these products to address the needs. We talk about need for coverage. I get this question a lot. People ask me, how much coverage do I need? And my response is always, as much as you can get. Because when we really look at it, we don't live on what we need. If we lived on what we needed, we wouldn't have the debt we have, and this country wouldn't have the debt we have. We live on what we want. And when you're disabled, it doesn't change. We want as much as we can get. Physicians and surgeons spend a lot of time getting their qualifications, and they work very hard to make a very good living. And so it's the most important asset they have. Our ability to earn a living is the most valuable asset that exists. If you're 35 years old, we have a 35-year-old surgeon that averages $500,000 a year to age 65. That's over $15 million in potential income. They don't have one single asset that's worth $15 million. Yet the disability insurance is something that's not paid attention to. Many doctors and physicians and surgeons are grossly underinsured. And many times what happens is they pick up $4,500 a month in residency, because the carriers will issue that on a guaranteed issue basis. They put it in their drawer and they go on to build their practice. And 10 years later, they're making a solid income, and they still just got $4,500 a month in disability. And if they become disabled, sick, or hurt, they're going to have a huge financial crisis. So it's very important to review your coverage. And I encourage you, if you haven't reviewed your coverage in the last 2 to 3 years, sit down with an advisor, sit down with us, and see what you have. First of all, find your policy and see what's involved, and see if it meets where you are today as far as your income, and as far as replacing as much of your income as you can. Because when somebody becomes disabled, they want to focus on getting better. They want to focus on recovery. And so they don't want to have to worry about paying bills, and expenses do increase when somebody's either sick or hurt. The risk of disability is much greater than most people think. Most people have life insurance, and they use that, and the disability is more likely to happen, about 3 times more likely than premature death. During our working years, 1 in 3 of us would be disabled for 90 days or more during our earning years. And the average duration of that is about 3 years. 48% of home foreclosures are due to disability. And so it happens more than people think it does. Interestingly enough, people think that injury and accidents are the major causes of disability, when in fact illness is the major cause. Over 75% of disabilities are caused by disease and illness. When I talk to people, I say, well, if I get hurt, if I get in an accident, that's really not the case. Stroke, neurological problems, cancer obviously is a major one, takes people out of the game. Surgeons pose a unique risk in that, because of the specialty of what they do, many things that will take a surgeon out may not take a general practitioner out. If a surgeon can't stand for a long period of time or they lose the use of one hand, they're out of surgery. And the surgery is what generates their practice. That's what drives their revenue. So they have a higher risk of a disability because it doesn't necessarily have to be catastrophic. And so they pose a bigger risk and really have more to lose than other specialties or general practitioners. Next slide, please, Wendy. So let's look at what's available. Individual coverage, individual disability is really the core of all disability planning. And individual policies are what are called non-cancelable and guaranteed renewable. And what that means is exactly the opposite of what it sounds. Non-cancelable means the carrier cannot change the rates on the coverage. Guaranteed renewable means that they can't cancel the policy. It has to stay in force until age 65 or age 67, wherever they've put it. So a non-cancelable guaranteed renewable policy means that once it's issued, the carrier can't cancel it, they can't change the rates regardless of what happens to your situation, regardless of what happens to your income. So if you take out $10,000 a month of benefit, even if your income went down, if you become disabled, they're going to pay out $10,000 a month. It also includes and should include a specialty and occupation definition. Now, there's a misconception out there because back in the 80s and 90s, the disability industry went through a huge change. Claims were up. Many carriers exited the market. And because of that, there's a perception out there that you can't buy what you used to be able to buy. There's a perception that you can't get specialty occupation, that you can't get the limits that you used to be, and nothing could be further from the truth. Specialty owned occupation is available. There are probably about 5 or 6 major high-tier carriers that still cater to the physician market, and they offer a specialty definition. And what that means is, for instance, for an orthopedic surgeon, it covers them as an orthopedic surgeon, and if they're unable to do surgery, then they're considered disabled. Because that's what drives their practice. So it's important to have that kind of definition in there, and it is available. And I talk to many people that say, well, you just can't get what you used to. And you can. I've been doing this for just over 30 years. And frankly, the coverage today is just about identical what it was in the late 80s and early 90s. The limits are sometimes the same, and actually some of the carriers have increased their limits. Generally, in an individual policy, you'll have a 90-day waiting period, which means that you have to be disabled for 90 days before you're eligible for benefits. From a cost standpoint, that's probably the most optimal. If you do less than that 60 days, it's much more expensive. If you go out to 180 days, the savings really doesn't justify losing 3 months of benefit. And for instance, there again, with a $10,000 a month benefit, to save a few dollars on premium is going to cost you $30,000 in benefit. Benefit periods now used to be to 65. They actually would go out to 70 now. You can buy 65, 67, or 70, depending on what you choose. Carriers will issue a certain amount of coverage based on income. 60% is always the rule of thumb. People say, well, you can get 60% of your income. But as your income goes up, as it increases, you can get into 6 figures, high 6 figures, and 7 figures, the amount that a carrier will issue reduces. It comes down. So they don't issue 60%. Most carriers today will issue a maximum of about $15,000 a month. However, they will participate with another carrier on a higher limit. So if you combine 2 carriers, you can get upwards to $20,000 to $30,000 a month using multiple carriers, but not go beyond their individual participation. The other benefit that you want to make sure you have on individual is what's called residual or partial disability. And that way, if you have a limited ability to practice, but you're still able to practice, and you have a loss of income, it'll pay you a proportionate benefit. And you can satisfy that 90-day waiting period either with a residual or partial or a total disability. So those are really the core. You want to have a non-cancelable guaranteed renewable policy, with a specialty-owned occupation definition, generally 90-day waiting period, and with a residual benefit. So if you haven't, as I said, if you haven't reviewed your coverage, I would strongly encourage you to sit down, take a look at it, make sure it's up to date. You generally don't want to mess with the coverage that you have because you took it out at a younger age, and as I said, the carrier can't take it away. But it's a good idea to see what limits you have and if it makes sense. To go back to the other slide, please, Wendy. To go back to the individual coverage. Now, once you have the individual in place, generally we'll take a look at group long-term disability. Now, this goes through the practice, and we can insure under group as few as 4 to 5 lives up to hundreds. And the carriers will guarantee issue a small practice. We have a private practicing physician with, say, 3 or 4 staff. They will guarantee issue $5,000 a month. And it's similar to the individual, but doesn't take the place of it because you can lose your group coverage. It can be canceled. The definitions and the guarantees aren't quite as strong as the others. Group disability is issued without underwriting, and the practice can pay for it. You can cover your staff for a small amount of money, and enables the physician to layer the group coverage on top of the individual and give them a higher percentage of their pre-disability earnings. And that's really the goal, is to get as much of your pre-disability earnings covered as you possibly can. Because nobody wants to take a drop in income. And in most cases, even if you get as much disability as you can, there's still going to be a gap there. And to address that gap, there is one carrier that offers an excess disability policy. And what this is for is, if we get as much individual coverage as we can, and then we layer the group on top of that, you're still probably going to have somewhere between a 30 and 40% drop in income compared to your pre-disability income. While you're able to maintain a level, a lifestyle, and maintain pretty close to what your lifestyle was, what's really going to suffer is your ability to save for retirement. That almost goes out the window because all your resources are going to be used to maintain your living. And hopefully you won't have to dig into your retirement to maintain that. So what this carrier does, it offers a lump sum benefit, generally from $500,000 to $3 million. It's paid after 1 year of total and permanent disability, and it's paid in a lump sum at the end of that 1 year. It also carries a specialty definition that's actually put on the declaration page of the policy. And so if you're a surgeon, and I'll go back to an orthopedic surgeon, if that orthopedic surgeon loses the ability to perform orthopedic surgery and it's determined that they're never going to be able to do it again, once they qualify after a year of that disability, they get a lump sum for up to $3 million. That replaces their retirement savings that they won't have the ability to do, that had they continued working, they would have been able to do it. And when we talk about, and we want to look at the taxation of it, individual disability is pretty straightforward. Unless you're a C Corp, you can't deduct the premium for individual coverage. Most practices are sub-S, partnerships, or LLCs, so they really don't have a choice under the tax code. So you're paying the premium with after-tax dollars, however the benefit comes in tax-free. And since the tax codes and the tax rates are vary, we don't know what they're going to be in the future, that gives you a lot of stability in knowing what's going to come in. Now, group long-term disability is a little bit different. You really have a choice there because the practice pays the premium. And so the practice can deduct the premium, and if it does that, takes a tax deduction, then the insured, when they collect the benefit, will have a taxable benefit. They pay taxes on whatever's paid. My recommendation to most practices is recognize that premium as income so you have a tax-free benefit. Because if we take the example of $10,000 a month, If that's taxable, you're really only getting about $8,000 a month. You're going to be in at least a 20% tax bracket under current tax laws. If tax rates go up, it would be less. The tax savings, if you deduct the premium, is just not that significant when you compare it to what the benefit would be down the road. And the excess disability is the same way. It has to be paid with after-tax dollars, and it's a tax-free benefit. But if you've got that kind of money coming in a lump sum, tax-free is much more favorable than if it were taxable down the road. I put in Social Security and workers' comp just to mention it. It's not something you want to rely on. Social Security will pay somewhere between $1,000 and $2,000 a month. 60% of all first-time Social Security claims are denied. It's difficult to get. So if it comes in, it comes in, but it's not really something we use as part of the planning. Workers' comp, there are very few disability claims due to workers' comp claims. And there again, the money is not that significant. So it really is not part of our planning. Okay, next slide. Now if we've got our income replacement taken care of, you've got individual coverage in place, we've got some group coverage layered on top of it, and if you choose to put the excess on top of it, then your income is replaced, your personal financial picture is much better. But what happens to the practice? What if you're a sole practitioner or in a partnership with two of you and you become disabled? You've got your income taken care of, but the expenses of the practice continue. And after about 60 days after receivables are exhausted, somebody's got to pay the rent, the staff, the insurance, or they just shut the doors. Business overhead coverage for disability was created so we could keep the practice open to have a practice to come back to. And it's generally written on a short-term basis. Usually we use, there again, a 60-day waiting period, meaning you have to be disabled for 60 days before benefits come in. And it's a reimbursement policy, and it'll pay up to 12 to 24 months. Usually 12 months is adequate. And what this does is it reimburses for all the fixed expenses of the practice. And that would include rent, utilities, telephone, insurance, the salaries of the staff, anything that doesn't have to do with the actual medical practice. And those expenses allow you to keep the doors open. So if it's a disability where you're going to be able to return in 8, 10, 12 months, you've got a practice to come back to. If you're not coming back to practice, then it gives you time to decide what to do with it, so you don't have to make any knee-jerk reactions. And it also doesn't have to come out of your pocket to pay these expenses in dealing with a lease or whatever you have set up. Now, most advisors generally will sell business overhead to small practices, either solo practitioners or maybe 2 or 3 partners. And many times the larger practices are overlooked. They have the same challenges that a small practice has. It's just of a larger scale. If you have a surgical practice with 10 partners and they're generating large revenues, if they generate large revenues, they have large overhead. If one of the partners becomes disabled, somebody's got to absorb their portion of the overhead. If they're one of the major producers for that practice, then they are responsible for a major portion of the overhead expenses. If they quit practicing, that has to be absorbed, and in many cases they have to let people go, and the other partners have to pick up those expenses, which nobody wants to pay more than they're already paying. So there is coverage available where you can go into practices, 3 or more. We can get a guarantee issue. They actually will issue up to $100,000 a month on a reimbursement for up to 12 months. And this keeps the practice going and doesn't put a burden on the other partners. Now, the taxation on business overhead is different than on individual. Business overhead is always a deductible business expense. It's considered a business expense. So the premium paid for the business overhead is a deductible expense. And so when we look at the premium for it, it's actually probably about 25 to 30% less than what we actually look at because you get the tax deduction. Now, when the benefit comes in, it's taxable, but it's a reimbursement for a write-off, so it's really a wash from a tax basis. There again, business overhead keeps your practice open to come back to. Your personal disability is replacing your income. Next slide, please. One area that's very often overlooked in partnerships is a disability buyout coverage. Let me just explain buyout. I get calls quite a bit, and usually it's on the life insurance side rather than disability. To say I need some buyout life insurance. Well, there's really no such thing as buyout life insurance. The life insurance or the disability insurance, either one, is nothing but a funding mechanism. The buyout agreement is what really drives the buyout. And the reason to have a buyout is if one of the partners becomes disabled, absent an agreement, their spouse becomes your partner. And that nobody really wants that. It doesn't make much business sense. So either in the partnership agreement or a standalone buy-sell agreement, the terms need to be determined on how a buyout is going to take place, whether it be life or disability. And that's what drives the buyout. The funding is really, there are options for that. The disability buyout funding, they actually have a policy that provides for that. It has a 1-year waiting period, meaning you have to be disabled for at least 1 year, and it actually will go up to 2 years. And it will fund either in a lump sum or a 2, 3, or 5-year payout. Now there again, that's a choice on funding. Once the agreement is set, the agreement dictates the purchase of the practice. And you can fund it either out of the practice revenues, you can fund it with a sinking fund, or you can insure it. And so the disability buyout is specific for the buyout on the disability side, just as the life insurance is. The taxation on this is very similar. It's a non-deductible expense, but it comes into the practice, and generally you have the practice own the policy, or if it's just two partners, you can have a cross-purchase and keep it out of the practice. But it comes in as a tax-free benefit, and then of course, if the practice is purchased, it's a capital purchase, so there's a capital gains. That's just based on the purchase, but there is no taxation on the disability funding and disability proceeds itself. Next slide. I put this in. There are a couple carriers that have what's called a pension completion benefit. You can purchase an amount over and above any other coverage you have. And what it does is it contributes whatever the amount that you contribute to a 401k, whatever the levels are for that year. And it puts the money into a trust for the insured's benefit. And as long as that person's disabled, it funds that based on the contribution level that year, puts it in the trust, and then at retirement age, they can start drawing that out as if they continue to fund their 401k. Because keep in mind, most disability benefits are going to end somewhere around retirement age 65, 67. And so if you don't have time to fund your retirement, there needs to be some contingency, and the insurance can provide that so that you continue to be able to maintain your lifestyle. So just to recap things, the disability is probably one of the most important and one of the most overlooked coverages that we have. I mean, our ability to earn an income is our most valuable asset. It provides everything else that we insure. And so it should be at the priority of your insurance planning to make sure it's taken care of. And we can do it with individual coverage, layering group long-term disability on top, and then an excess policy to take care of your personal needs. There's business overhead protection that allows you to have a practice to come back to or decide what to do with the practice, taking care of your fixed expenses. If you're in a partnership, we can cover the buy-sell in the event of a permanent disability, and a buy-sell is enacted, and there's also a way to cover your pension. And so that's just a general overview of where the market is today. As I said, if you haven't reviewed your coverage, I would strongly encourage you to do it, because you don't want to wait till disability happens, because once you become disabled, Whatever's in place is it. There's no turning back. So it makes a lot more sense to do the planning while you're healthy and while you're able to do something about it. Thank you very much for your time.
So if anyone has any questions, you can type them in and we can spend a little bit of time answering. Wes, I do have one question that came through. I've heard from some of my doctor friends who are on disability that carriers are difficult to deal with. What are your thoughts around that?
I get that a lot, and unfortunately, usually people hear the bad stories rather than the good. What generally happens, and what I've seen in my experience, is not the fault of anybody really. What happens is there's the disability process, the claims process is not difficult, but it's time consuming. There's a lot of paperwork, there's a lot of reporting, and the insured has reporting to do and the treating physician has reporting to do, and they're both sending in questionnaires and reports to the claims department of the carrier. What the main problem that you run into is that the treating physician's report is not agreeing with the insured's, and that's largely due to the lack of communication between the patient being treated and the treating physician. Depending on how good the notes are for the treating physician and how detailed they are compared to the insured is what drives that. So if the treating physician is not taking good notes and sends something in that conflicts with the insured, then that's a problem with the claim, and the examiner's looking at what the doctor says. So I would say it's very important to really have a strong communication with your treating physician and make sure that what you're sending the carrier at time of claim agrees on every point, and that makes the claim much smoother. And that's probably one of the major problems I see, and people don't really understand that until they get into the process.
Okay, it looks like I have a couple more here. So Javier, we are part of a group MSO that offers disability. Is this extra or over coverage if we have it offered by our group? Does that make sense?
Not totally. Well, I mean, if you've got group disability, that's all the group disability you would be eligible for.
So we're members of Florida Woman Care, I guess, is
okay. Yeah, if you've got group with them, then that's enforced. You can't get any more group insurance. You could purchase individual insurance in addition to the group insurance you have, and you could also purchase the excess coverage, which would sit on top of both of those. The excess does not conflict with any other coverage. So whatever you have with group, you could add individual, and you could add the excess coverage too.
Okay. And Javier, if that didn't answer it, I'm going to put up Wes's contact information. You can reach out to him. Cheryl has a question. Are any of the individual coverage options guarantee issues?
Very rarely. I mean, there are some individual guarantee issues, but they have to be fairly large groups, and meaning you have to have 10 participants or more. And there are some carriers that will issue a guarantee issue up to certain levels. There again, depending on the numbers, they'll issue a certain amount based on that. To answer your question, yes, it is available. It just depends on the size of the group and the number of participants.
Okay, great. All right, so I want to keep you guys in a 30-minute webinar during your lunch hour. We really appreciate you joining us. We hope that we provided some valuable information. Wes is available for any additional questions, so you can email him or call him regarding anything, and we will also make this webinar available to you. Probably you'll get a copy of it tomorrow if you want to share it with anyone else in your practice or any of your friends. And we thank you and have a wonderful rest of your day.
Thank you, Wendy.